Types of assets. An asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide future benefit. Assets are bought to increase the value of a firm or benefit the firm's operations. You can think of an asset as something that can generate cash flow, regardless of whether it's a company's manufacturing equipment or an individual's rental apartment. Cash. Cash is money held by the company in its bank accounts. Cash equivalents. Cash equivalents are extremely liquid assets. Examples would include U.S. Treasury bills, which have a term of less than or equal to 90 days. Marketable securities. Marketable securities, or short-term investments, are debt or equity securities held by the company, treasury bills, money market funds, notes, bonds, and equity securities. Different companies may categorize their liquid holdings as either cash equivalents or marketable securities. Both are considered very liquid or easily converted into cash. Accounts receivable. Accounts receivable represent sales that a company has made on credit, or the product has been sold and delivered, but the company has not yet received the cash for the sale. Inventories. Inventories represent goods waiting to be sold and direct and sometimes indirect costs associated with the production and procurement of these goods. The composition of inventories depends on the nature of a company's business. They typically consist of three major categories. 1. Raw materials. Raw materials are used in the manufacture of the finished product, such as crude oil and food products. Work in progress. These are products in the process of being manufactured, such as cars, computers in the middle of assembly. And finished goods. These are products that have been completed and are ready for sale, such as clothes, books, and cars. The next type of asset is deferred taxes. The income tax expense that a company records on its income statement in accordance with the General Accepted Accounting Principles, or GAAP, does not always equal the taxes a company actually owes to the IRS. For the purposes of reporting financial statements to the public through the SEC, companies prepare their financial statements in accordance with the GAAP. Companies trading in exchanges outside the United States may report in accordance with the GAAP of their respective countries. Under GAAP, tax expense is calculated based on the GAAP pre-tax income. However, in addition to reporting these financial statements, companies must also prepare financial statements to the IRS for filing tax returns. The differences between GAAP tax expense and IRS taxes payable are recorded as deferred tax assets and liabilities. A deferred tax asset is created when tax payable to the IRS are greater than those recorded on financial statements. The next type of asset is other current assets. This is a catch-all category that includes miscellaneous current assets such as short-term investments, prepaid expenses, and these represent operating expenses that have been prepaid by the company in advance for the services it is yet to receive. Such operating expenses include insurance premiums, property rents, and salary advances. Deferred tax assets, therefore, represent potential future tax savings. Property, plant, and equipment, or PP&E. This represents land buildings and machinery used in the manufacture of a company's services and products, plus all costs, including transportation and installation, necessary to prepare those fixed assets for their service. The next type of assets are intangible assets. Intangible assets comprise non-physical acquired assets and include branding, franchise, trademarks, patents, customer list, licenses, and goodwill. These intangible assets are items that have value based on the rights belonging to that company. The next type of asset is goodwill. When companies acquire other companies but pay in excess of their fair market value of the assets and liabilities acquired, the excess of the purchase price over the fair price of the assets and liabilities is accounted for is purely conceptual asset called goodwill. Goodwill is the amount by which the purchase price for a company exceeds its fair market value, representing the intangible value unaccounted for in other assets stemming from the acquired, like the company's business name, customer relations, employee morale, etc. It is important to remember that goodwill is created only after all the identifiable physical and intangible assets, such as patents and licenses, have been assigned fair market value.